Hello, my name is James Neathery. Welcome to the Banking with Life Q&A series. This is where I answer questions that you have concerning the infinite banking concept. So let's get started. This question: where does money to fund a policy come from? Regular W-2 wages, 1099 income, money from investments? Well, I prefer after-tax dollars, whether it's W-2 or net 1099. Other investments, I'm not giving any investment advice. If you need investment advice, you need to seek out the appropriate professional. But where does the money come from? You know, you need to determine that. Where's your money going right now, and how much control over it do you have? Okay, so I prefer after-tax dollars personally. How often does a policy pay out dividends? Are they tax-free? That's a great question. Dividends are paid annually. They're paid by mutual life insurance companies. Are they tax-free? They're not taxed currently, and you have the owner of a policy has what's called dividend elections. They can tell the company what to do with the dividend. There's typically between the life insurance companies 4 to 6 dividend options. I can have the dividend paid to me. I can have the dividend remain with the company at interest, and that's the only place interest is involved in a whole life insurance policy other than the loan interest rate. Okay, I can have the dividend to reduce premium. I can the owner can tell the insurance company to reduce a loan. I can have the dividend paid into the paid up additions. So there are options that I have as the owner. It's my choice what to do with the dividend. And I have 4 to 6 choices. Are they taxable? Now, the life insurance policy, when I pay a premium, that premium is my basis. So over time, I paid an X number of dollars of premium. That is my basis. The dividends, it's what do I do with the dividends? So the short answer is no, dividends are not taxable, but they could become taxable in the future because they're part of my basis. So if I paid in premium and dividends, $300,000 in total premium, I get mad and quit, leave, surrender a policy with $400,000 in cash value, that's a taxable event. Okay, so the dividends add to my basis. The proper classification of a dividend is internally in that policy, it is accumulating tax deferred. It's accessible tax-free through loans, collateralization. The IRS classifies the dividend as a return of premium. All right, so it's not a dividend in the sense of a stock dividend. I buy Coca-Cola, they pay me a dividend. And I think we've done podcasts on dividends. This question: is interest on a loan simple or compound? Is it variable or fixed? Okay, it's a simple interest loan. It's unamortized interest. It's an annual rate. So if I borrow $10,000 today at the beginning of the year, that interest is charged to me on an annual basis. So if I don't make any loan repayments in the next year 2 in my example, I have a $10,500 outstanding loan because I didn't reduce the interest. I didn't make any loan repayments. So it compounds right then. In year 2, in my example, 5% is added or charged against the loan balance of $10,500. So the owner of the policy, I can amortize that loan repayment schedule over any time period I want to. I can treat it as an unstructured interest-only loan. I can treat it as, a 30-year loan repayment, a 15-year loan repayment, and so I can do what I want. The short answer is it's simple, unamortized. If I don't make any loan repayments, of course, the loan's going to compound. Right? Okay. Is it variable or fixed? It depends on the company. Some companies have fixed rate loans. Some companies have variable loan rates. And typically on a variable loan rate, it's tied to something. You know, they can't just get up one day and say, oh, we're going to raise your loan interest from 5 to 20%. So you need to do your homework and understand the loan provision of your policy. As a matter of fact, all right, you should understand the loan provision of your policy and the paid up additions of your policy. That's a question that may not be answered here. I'm just encouraging you to educate yourself. What can cause my policy to lapse? Great question. Number one is a non-payment of premium. That's number one. Well, if I'm paying a premium and I'm taking maximum loans, and that loan out compounds a cash value in the future, that policy is going to lapse. And I think that this is an area that's under addressed in the infinite banking world. So the short answer is non-payment of premium and a loan out compounding the cash values in the future. What kind of fees, if any, does your team and the insurance company charge for holding my money? Transactions, loans, and for exiting a policy. So when you exit a policy, we're specifically talking about the surrender charge. So the cost, there's no fee for surrender, but if you've paid in $100,000 in premium, you surrender the policy for anything less than that. That's your cost. That's your loss, right? I paid in X number of dollars. I'm walking away with anything less than that on surrender. That's a loss. You're not writing that off under current tax law as it's not a deductible loss. If you've paid in cumulative $100,000 in premium, my example, and you surrender a policy and you have a surrender value above $100,000, that's ordinary income taxable. The insurance companies charge a interest loan rate, right? So they charge an interest rate on outstanding loans. There are no transactional fees with the companies that we engage with. And then my company does not charge fees. We get paid, and we get paid by the insurance company, so we don't charge our clients. Thank you for watching. If you have a question that you would like an answer to, email us at the email below. And be sure also to like and subscribe and join us weekly for content. Have a great day.